First off, just want to thank everyone for taking the time to join Erik and I. My name is Brad Janitz. I'm Senior Director here at Equity Trust Company, and joined by Erik Gebhard of Ultivest. Together we're going to talk about a couple things. First, we're going to talk about tax-advantaged accounts and what those are, what they mean, and how we can use them for futures trading. And then Erik's going to jump in on the back of this presentation to discuss some of the unique tools that they have around stock index options and the software that they provide, and some of the cool tools that they have for you to take advantage of trying to make some money and wrap that into a tax advantaged account. Okay, and so what really brings us here today, at this particular time of the year, first, it's summer's behind us. So what that means is that now we're progressing to the end of the year. This is typically the time where people start sort of thinking about their goals, financial goals, and their tax burden that lies ahead come April. And so we wanted to kind of take a step back and sort of kind of reintroduce some concepts that you probably know about, but just sort of make sure you have a fundamental understanding of some of the tax advantaged accounts that are out there and how to use them and sort of the power and benefits of them. And then also there's a sort of I've been doing this job for 15 years and talked to people using tax advantaged accounts for investing, and a lot of people just don't really understand the flexibility of these types of accounts, how to move them around and take advantage of opportunities within lots of different markets. And so really we want to break down those barriers and make sure you have a fundamental understanding of both tax advantaged accounts and then how to use them for futures trading or just investing in general. Okay. And so who is Equity Trust? What do we do? So first, we're a financial services company, been around for over 50 years with over 58 billion in assets under custody. That stat's actually outdated. We're roughly around 70 billion as it stands right now. But really of that $70 billion used, that's all tax advantaged money where we're enabling individual investors to diversify their investment portfolios into alternative investments. And we'll define that momentarily, but really it's sort of taking tax advantaged money and sort of retooling it outside of what you've sort of been accustomed to being educated on by either advisors or through school on very traditional markets. And so really we at Equity Trust specialize in you sort of carving out of that mindset, moving tax advantaged money around, and then taking advantage of alternative investment opportunities. All right, and so what are some examples of tax advantaged accounts? And so here's sort of, if you look at the circles on the left, this is primarily employer sponsored retirement accounts. So think 401ks, think 403bs, 457. So things with numbers usually mean employer sponsored plans. But then that can also be broken down into your sort of vanilla IRA accounts, which is your Roth IRA and traditional IRA. And then you can break it out into the health arena, where you have health savings accounts like HSAs, which are becoming super popular today, given where healthcare is and the added expense there.
Brad, just one. Can you hear me, Brad?
Yeah. Yeah. Go on.
We're showing the home screen, your first slide. Are you on the next slide?
I am. So yeah.
Okay.
Sorry.
Yeah. There we go.
Okay. Maybe I'll just operate it from here. I don't know what's happening in the system there. So yeah. So my apologies there. We'll just kind of keep it going from this perspective. Hope that's okay with everyone. So what we're going to really keep our focus on, and Erik, do you see what is a self-directed IRA slide?
Yeah.
Just to make
sure.
You're
good now.
Okay, cool. So really what we're going to focus on today is what is a self-directed IRA. And I'll kind of tap into why we're going to focus on this here in a bit. But really, this is the retirement account, or this is a sort of the most, I would say, when you look at retirement account investing, I don't think most people know this, but when you sort of like take a look of a snapshot of your wealth, or actually the majority of Americans' wealth out there, 70% of your investable assets are typically within retirement accounts. So think about that. Like anybody you could sort of meet at a coffee shop or walking through grocery stores, you see hundreds of people. Um, for the majority of Americans out there, whether you're rich or poor, your bulk of your investable assets are within retirement accounts. And so that's really why we're going to focus on retirement accounts today, just so again you understand the types of the strategies that are out there around retirement accounts. And then also they're the easiest from an investment standpoint to maneuver around. So there's a lot of more flexibility towards retirement accounts and what you're capable of doing. And also there's one intent for retirement accounts, and that is to invest your money and make money all within a retirement account so that you can take that money and live off of it and enjoy your retirement account, enjoy your retirement later in life. And so my industry is sort of defined by this term, what is called a self-directed IRA. And really what that means in the scope of equity trust is that a self-directed IRA is not really a special type of IRA. It's more of an ideology. So a lot of times as people sort of build wealth through 401ks, their money is sort of quote unquote managed. So it's usually managed by an advisor or an employer that's sort of picking and choosing mutual funds for them to invest their retirement accounts. And then maybe you level up to a financial advisor that's then taking it upon themselves to make those choices for you. And the reality is a lot of those choices are still within sort of vanilla based mutual fund environments. And so really our ideology is sort of removing that advisory relationship in the more traditional sense, and sort of opening up that landscape to say, hey, I have this bucket of money in a retirement account, or maybe I'm starting from scratch and I want to take control of where that money is being headed and how it's directed myself, because I feel like, hey, I've done the homework, or hey, I want to do the homework, I want to do the research, I want to learn new markets and new opportunities and take advantage of those myself. And so that's really what a self-directed IRA is it's a retirement account where you have the full decision authority over that retirement account. And then in addition to that, it's being housed with a custodian. That's what we are. Equity Trust at the end of the day is we are a custodian of assets. And really what a custodian's role is to provide the administrative layer around your retirement account. So tax reporting, making sure money is going to where it needs to be going. Rules are followed with respect to guidelines that the IRS has put forward, but then allow you access to different markets. And so what you'll find with more of your traditional brokerages is that they allow you the opportunity to invest in stocks and bonds and mutual funds, but they limit it to that bucket. Where we at Equity Trust are a believer is that we open up that bucket to allow you access to other investment classes that you might find interest in. Okay, and so what are some examples? So if you find, again, on the left, kind of in a more limited bucket, the stocks, bonds, and ETFs, which, hey, everyone probably should have some subset of assets in those positions. But then there's, again, a whole other subset of things out there that people can invest in. Futures trading being one of the more popular options that people use Equity Trust for. Again, we'll dig into what that means. But then you can see all of these different things here, startup companies, cryptocurrency, real estate, all sorts of different opportunities and markets that are out there. And you just have to understand how you can move money around and take advantage of these opportunities when you find, that opportunity presents itself. Okay, and so account funding, IRAs and Roth IRAs are traditionally sort of funded in really these four ways, right? So option one is kind of your most popular thing. So people, you get out of school, you go to work, start at a company, they provide a 401k plan, you participate in that 401k plan or 403b or 457, some sort of employer plan, and you're gonna put away 5, 6, 7% of your paycheck over time, and then that company may match it, and then over time you're going to sort of build up that 401k throughout time. And so then what people will do with those 401ks is then roll them into IRAs, because when you're in a 401k, you are often limited to what you're allowed to invest in because of just the nature of 401k plans and their fiduciary restrictions. And so you have these employer plans, so then after you leave that employer or you job hop or you retire, however that works, then you can move that 401k into an IRA account. And then that offers you that self-directed flexibility to be able to sort of do the things you want to do. So again, what I mean by that, you work at a company, you build up a 401k. Let's say you have $100,000 in that 401k after 10, 15 years. You can then take that 401k and roll it into an IRA account. And there's no tax consequence for doing that. You're just rolling that money into an IRA account. And then when it gets to that IRA account, then you can invest in really whatever you see fit, whatever opportunities that you want to take advantage of. Okay. And then we'll dive into some of the finer details of this, but then you can make contributions to IRA accounts or Roth IRA accounts. And so what that means is you're taking personal money from your bank account and then depositing it into another account, which that other account could be a traditional IRA or Roth IRA. And there are rules around this, but also tax benefits to these. So we'll sort of dive into that. And then the other kind of tip or trick that we're going to talk about today is the Roth conversion. And also another trick is the sort of backdoor Roth IRA. So super popular time for people to try to figure out how to get money into Roth IRAs. And we'll talk about why you want to do that and sort of some of the benefits around it. Okay, so again, we're going to dive into two retirement accounts, and some people may find these particular accounts to be sort of basic because they've been around for a long time. But again, as I kind of notated at the beginning of the presentation, I think some people oftentimes just kind of forget some of the nuances to these things or some of the benefits to them. And so we just want to talk about, hey, how do you get money into a traditional IRA? What are the benefits of the Roth IRA? And then also, hey, is a Roth conversion maybe right for you? And what that actually means. Okay, and so let's talk about just the taxable money versus traditional IRA money versus Roth IRA money. Why would you even put money into a retirement account or into an IRA account? Okay, so when you put money into a retirement account, when you invest that money within a retirement account, then you do not pay taxes. Okay, so you don't pay taxes when the money is within a retirement account. Okay, so when you look at this first bar here in the taxable account, so when you put money into a taxable account and you're making money on investing, when you realize those gains on investing, you have to pay taxes. It's taxable income to you. And I know futures trading does have some benefits towards the tax treatment of realized gains, but you still, at the end of the day, will be paying taxes on gains on an annual basis. And that's important to understand because when you invest that money within a retirement account, you don't pay taxes on an annual basis for realized gains. Okay, and so that's why you'll see when you go to the second bar, the traditional IRA, when you put money into a traditional IRA and you invest it, and you can play with the sort of the return profiles based on these numbers here. But the reality is that when you put money into a traditional IRA, you get a tax deduction for doing so. And then when that money's within that traditional IRA, you don't pay taxes. So when you invest $5,000, you turn it into $100,000, and you sell out of that position, it is a tax-free position. Okay, and so you don't pay taxes on those realized gains. And so if you make good decisions over time, you can really sort of build up a nice heavy nest egg, kind of compounding those returns over time. And then you just get to add fuel to the fire on the third bar, which is the Roth IRA, which is just basically the tax-free IRA account. Okay, so the difference is here, when you have a traditional IRA and you deposit money into a traditional IRA, you get a tax deduction for that. So you basically take off $6,000 or whatever you deposit off of your tax basis, and then you invest that money over time. You don't pay any taxes on the money that you make throughout time with that money in there. But at some point, you do have to pay some taxes with the traditional IRA. So when you're, say, 59.5 or 65 or 70, and you decide that you want to take money out of your traditional IRA account, and let's say you take a $10,000 distribution well, then that $10,000 is going to be taxable to you at your ordinary income tax rate. And sort of the theory is that you're saving money now because you're working or potentially working, and you're making more money, so you're going to be at a higher tax bracket. When you retire and you take money out of your traditional IRA, you're going to be at a lower tax bracket. And so basically you get the compounded tax savings over time with being able to reinvest, realize gains, and not paying taxes each year on that money. And then also when you actually take the money out, you're going to be at a lower tax bracket, so you'll save money then. Okay. Now, if you don't buy any of that and you're like, hey, I don't believe that I'm going to be in a lower tax bracket when I retire, well, then the Roth IRA is for you. And so what that is basically you don't get a tax benefit for putting money into a Roth IRA today. So if you put $6,000 into a Roth IRA, there's no tax benefit to you in the immediate for doing that. Okay. But when you invest that Roth IRA, you don't pay any taxes on the money you make. So if you buy $5,000 of something and you sell it for $100,000, again, you don't pay any taxes on that money that you just made. And then over time, once you hit the age 59 and a half and you've had that Roth IRA for 5 years, any money you pull out of that Roth IRA is completely tax-free. Okay. And so that's why you see that gray chart being a little bit higher than the traditional IRAs, because the traditional IRA, you do have to pay taxes at some point. Roth IRA, you pay no taxes. So 59 and a half, and you've had that Roth IRA for 5 years, is a tax-free account to you. Okay. It's the most powerful tool that there is in wealth building. Okay. And so this is just sort of to show that, it's impactful to save within retirement accounts. Okay. And just save in general. So, I mean, this is just a chart to just kind of hit home, like, hey, if you look at the light blue bars here, somebody is making $3,500 contribution annually into their Roth IRA. Still super impactful. They're doing a great job of saving for retirement. But if you can stand to just put $3,500 more in, and you hypothetically talk about a 7% annual growth, then it's almost going to double after 40 years. Now, 40 years is a long time, but even then, you can just see that those blue bars are sort of incrementally like being dramatically different over time by just an extra $3,500 a year going into a Roth IRA. So just kind of crazy to think about what's possible as you sort of consider what you can put away, and maybe getting uncomfortable at the onset with putting a little bit more than you're comfortable with into a retirement account, but then the benefits that can have later down in your life are just super impactful. Okay. And so what are sort of the rules and the limits with getting money into traditional IRAs and Roth IRAs? So Roth IRA and a traditional IRA, $7,000 a year if you're under the age of 50, with the catch-up contribution of $1,000. So if you're over the age of 50, then you can do $8,000 a year into a traditional IRA or a Roth IRA. And again, traditional IRA, you get a tax deduction for doing so. So if you put $7,000 in, that's $7,000 that comes off of your tax basis. So you'll save on federal and state taxes when you do that in the immediate. Or you can do the Roth IRA where there's no tax deduction for doing so, but then you get that tax-free account in the long run over time. And so one little, I guess, thing to consider is at some point, if you are covered by an employer plan, the government does say, hey, these retirement accounts are pretty powerful. You can build up a lot of wealth really fast. So we just want to let you know about some of the rules with respect to that. So what that means is if you are covered by an employer plan, so you go to work every day, and you are covered by a 401k plan, meaning you participate in that. Well, then the government says, hey, if you make a ton of money or a lot of money, that's all relative to the person, but then you sort of phase out of being able to get a tax deduction into a traditional IRA. Okay, you can always make a contribution to a traditional IRA. So if you're a real big believer in compounding interest over time, then you can still make what is called non-deductible traditional IRA contribution. So that way you may not get the tax deduction for going into a traditional IRA, but you can at least get it in there. And then that way, when you're investing that money over the next, 10, 15, 20 years, you're not paying taxes on any of the gains that you make. Okay, so again, super powerful tool in these IRA accounts, but the government does sort of have some rules to limit how much money you can get into them at times. Okay, and so here's just sort of some guidelines in front of you, so you can sort of see that, hey, if you're making more than 146,000 as a married filing jointly, so you and your spouse together make over 146,000, that the government's going to say, hey, we don't want you to get a tax deduction for your traditional IRA if you are also covered by an employer plan. But I will tell you here momentarily why you may want to do this non-deductible IRA, because you're probably asking, why would I ever do that? I'll just do a Roth IRA. Well, there is a reason behind that, and which I'll get to momentarily here. So what do you need to contribute to an IRA? So you do need to earn income. All right, so really what earned income is that you're making money through providing goods or services. Okay, you're basically, you work for a company that employs you and pays you for your services, or you're providing some sort of goods and services effort towards and receiving compensation for that. So what that really means is that investment income doesn't count. So if you're just trading, making money off your trading, that doesn't count as earned income. There are some tricks you can do around that by creating an LLC and sort of creating your own business around trading. Then you can pay yourself a salary and sort of create some earned income in sort of creative ways. But just ordinarily, if you open up a brokerage account and just sort of trading under your own personal name and making trades, that's not going to count as earned income. So I know that's important for this crowd to understand. Okay, and so the backdoor Roth IRA contribution. So this is sort of something that wealthy people have taken advantage of over years, and has only now became sort of I guess coined the backdoor Roth contribution. And so what does that mean? So that means there are limits to what you can to who can make a Roth contribution. Okay, so if you make too much money, then the government's not going to allow you to make a Roth contribution, because they want you to basically, pay taxes. So kind of going back to this one slide on the non-deductible contribution, it's relatively in the same range. For whatever reason, I don't have that graphic, but it's relatively in the same range. So if you make over, $146,000, it is different for Roth IRAs. So don't quote me on specifics here, but if you make around these ranges, then you're going to be ineligible for making a Roth IRA contribution. So, but there's lots of people that still get money in Roth IRA accounts, and how they do that is through what is called a Roth conversion. Okay, and so what that means is you're basically converting traditional IRA money to Roth IRA money. Okay, and so why people do this is because, going again back to this slide, in a non-deductible IRA contribution, you can always make a traditional IRA contribution, okay, regardless of whether you work at a 401k plan or whatever, or if you make too much money, you can still make a non-deductible IRA contribution, and then you can convert that to a Roth IRA account, okay? And so this is what people call the backdoor Roth contribution. So, we allow people to do this at Equity Trust. Even if you don't work with us at Equity Trust, you can do this at any brokerage that provides IRA accounts. But this is basically a mechanism to get money from an IRA to a Roth IRA. You just have to either call us at Equity Trust to set up the two account types. You make your contribution to the traditional IRA, and then you convert that money from traditional IRA to Roth IRA. Okay, and then basically you get the money into a tax-free account from there. Okay, and so what does that mean though? Okay, so when you convert money from a traditional IRA to a Roth IRA, there is a tax burden that happens. Okay, so basically, when I at the beginning said, hey, when you're contributing money to a traditional IRA and you get that tax deduction for doing so, All right. And with a Roth IRA, you don't get that tax deduction, but then it's tax-free down the road. Well, basically what you have to do is when you convert money from a traditional IRA to a Roth IRA, you have to pay taxes on the money that you convert. Okay. So let's say that you have a $100,000 traditional IRA account. Okay. You can convert any portion of that into a Roth IRA. So if you want to do the whole thing, because you're in a, maybe a downtime in income, or maybe you just want to do a portion of it. Maybe you just want to do it over time and want to do $5,000. Okay, well then you're converting $5,000 traditional IRA money into Roth IRA money, and so, but you do have to pay the taxes now, so you don't have to worry about it in the future. So if you convert $5,000, that $5,000 is then taxable to you for that particular tax year. Okay, so then you fall into an ordinary income tax bracket. Okay, let's say you pay 18% on $5,000. Okay, but then that money is now in a Roth IRA. You turn that $5,000 into $100,000 over the next 10 years. You won't pay another dollar of taxes on that money over time. Okay, so that's why people do it, is to get that money from a tax deferred account into a tax-free account. Okay, and so these were strategies that, for example, Peter Thiel, one of the PayPal founders, he now has a $500 million Roth IRA account. And he basically did that through this strategy of converting traditional IRA money to Roth IRA money and then making good investment decisions within his Roth IRA account. So now he has a $500 million tax-free account. So if you can get money, if you can handle the tax burden on the front end to get your traditional IRA money over into a Roth IRA account, then it can be a super powerful tool to help you build wealth later in life. All right. And again, you can do this in stages. You can convert in stages. You can convert for specific opportunities. And then the discount conversion strategy. So sometimes, when you go through each year, you're going to make more or less money on occasion. So if you find yourself in a particular year where maybe you made less money, or you just converted jobs, or maybe you started a company, maybe something that just took your income down a level, well then you can convert then, because you'll be in a lesser tax bracket, and then basically the taxable income that you have to pay is less than maybe if you did it when you made more money and you're at a higher tax bracket. So just got things you got to think through as you sort of go through time. And if you're a believer in sort of the power of the Roth IRA, then maybe just sort of take a step back and think about, hey, long term, do I want to get this traditional IRA money into the Roth IRA? What does my tax situation look like today? And if it's in a particular year where either A, you have the money to afford it, or B, you're in a lower tax bracket and you have the money to afford it, then it can be a powerful situation to convert that money to a Roth IRA account. Okay. And so now, all right, a bunch of stuff about traditional IRA accounts, Roth IRA accounts, and at the end of the day, what you want to do is you want to trade some futures with it, because that's what we're here to talk about. And obviously, you guys have a sort of a belief system or an interest in trading futures in the futures markets. And so how does that work? What do you do here? So the first thing is, so what we do, alongside AltaVest, we're sort of partners in this relationship to bring this IRA for you to trade futures together. So it takes both parties. And so at Equity Trust, we're not a futures broker. Okay, so we don't allow people to trade futures directly with Equity Trust. What we are is the mechanism that allows you to establish an IRA account, move money from an existing retirement account, or make a contribution, or roll over a 401k, get that money over to us at Equity Trust. And then we'll go through a process of you establishing a relationship with a broker, such as AltaVest. So when you establish and you complete that application process with AltaVest, you'll indicate to them that, hey, you want this AltaVest account to be linked to an Equity Trust IRA, which then allows you to fund your AltaVest account with IRA or Roth IRA money. And then you can trade with AltaVest on the tools and strategies that they allow you to do. And when you make money again within that AltaVest account, it all is wrapped within your traditional IRA or Roth IRA, so you get all the great tax advantages that we just rattled off here throughout this presentation. Okay, so really here are the steps that you follow. you contact us. We'll kind of walk you through, hey, what does your retirement account situation look like? Are you starting from scratch with a new retirement account? Are you rolling over a 401k? Maybe you want to do a Roth conversion from a 401k to a Roth, or a traditional IRA to a Roth. So we'll sort of talk through that with you on what that plan needs to look like. And then after you open that equity trust account, then we'll work with you to make that, again, get that money from point A to point B. And then you'll go through the process of establishing that relationship with AltaVest. And then after that, it'll be up to us, AltaVest and Equity Trust, to link those accounts together. And then once that happens, then we'll get your money over to the brokerage account where you can actually facilitate your trades. So again, you won't facilitate trades through Equity Trust. We're not involved with that piece of the puzzle. We don't charge any fees associated with that. It's all, hey, what you do with AltaVest, and you know, how those products work is how that's all going to look. And Erik's going to walk you through what that looks like on their systems, so you can get familiar with their product set and what some of the tools that they can offer for you. Okay. And so again, what do you need to know about just sort of this setup and Equity Trust and our involvement? All trades, again, are executed with your broker. Equity Trust is not involved with your trades. When you look at your statements from your AltaVest or futures account, they're going to read as Equity Trust is the custodian. So it's going to say Equity Trust as custodian for the benefit of you as the underlying individual. And so that sort of titling defines that chain of custody that your IRA account is housed with Equity Trust. And then what that means is, again, we're wrapping that account within your IRA to allow you the flexibility to access different markets and the options markets and the futures markets. And then we will be responsible for any of the tax forms that are necessary for any tax filings that you have to do. So most of the time these are not necessary, but if you decide to take distributions or make contributions, there are tax forms associated with that, which we'll provide to you so that you can appropriately get the tax benefits that you need from establishing those retirement accounts. Okay. Again, my name is Brad Janitz. I'm pretty reachable. So if you want to chat with me, just reach out to me. I'm happy to talk and have a conversation and just sort of help make sense of all this as it relates to your specific retirement account situation. And then with that said, offering up a little discount today. So if you do want to move forward with Equity Trust to trade with AltaVest, we do offer a discount, sort of a short-term discount over the next couple months here. And again, you can reach out to us, but to get started, trustetc.com/start. Be very clear to go to that specific page, and then you can save $50. So basically that $50 gets you a free account to trade with AltaVest. So it bypasses the setup fee that we would ordinarily charge to get you set up with us. And so then therefore you can set up, you can get your account funded, and then we can progress from there. Okay, so now I'm going to, I guess, Erik, are there any questions that maybe we need to address?
Yeah, good presentation. That was very helpful, even for me, after having been in business for a couple of decades or more. That was still very helpful. So thanks for that. There was a question I actually took care of earlier, and I don't see anything else at the moment in the queue, but there may be some that come on in. But yeah, thank you, Brad.
Awesome.
All right, and with that said, we're going to switch gears here, and I'm going to jump over and share my screen. Okay. All right, so we're going to talk about some of what we do here at AltaVest with trading futures and options. And feel free to jump in with any questions along the way. I do see a couple questions here. Let me mention these. I don't know, can you see those questions as well, Brad, or is it just on my end? But I'll read it for you here. The question is, okay, it says, or does it also apply to regular after-tax investment account? Is this arrangement only about IRA money?
Is that towards the discount code? So I think, so yeah, Equity Trust is really only involved with respect to IRA money or tax advantage money, HSA accounts, IRA accounts, etc. So yeah, the discount code of the $50 savings would apply if you are looking to set up an IRA account with Equity Trust to invest with AltVest. I hope that answered the question.
Yeah, and encourage everyone to keep asking questions along the way, whether it's for Brad or myself as I go through this. But here is our risk disclosure, and I know it looks like a lot to take in, so feel free to take a screenshot of that or capture an image on your phone if you want to read every detail for bedtime reading. But really the most important thing here is there's always risk involved when trading. You should use risk capital when trading, and past performance is never a guarantee of future results. So that's the main thing. And we've already had our conversation there with Brad and a little bit about AltVest. Since 1997, we've been a registered introducing brokerage firm. We have proprietary options technology. We've traded millions of contracts along the way. And we're registered with the CFTC, member of the NFA. We're located in California. And I'm Erik Gebhard. I'm a co-founder of AltVest. I have my BS in Business Administration from USC, or University of Southern California. I formerly had my Series 6 mutual fund, annuities, insurance license. Currently have my Series 3 commodity futures license, as well as a Series 65 for investment advisors. And maybe you've seen some of our presentations in the past on various, I guess, webinars and so forth. And if not, that's fine too. And we've often get quoted in the press. Maybe you've seen us on Market Watch a few times. I don't know, seems like it kind of comes and goes. This is from July here, where they talked to us about trading gold. Talked to my business partner, Mike, there about our outlook on gold, which, by the way, we've been bullish on. We had a special gold presentation about this time last year about being bullish on gold. So anyhow, I think the run in gold is not over, if you want to know. But anyway, if you want to talk about three common barriers to trading, these are, I guess you could say, what we've come to determine after years and years in the business and talking with thousands of clients. So see if you can relate to these. Number one, confusion, a lot of noise in the media, in the landscape when it comes to investing, conflicting targets, narratives, opinions, a lot of clickbait. This is price targets from Wall Street. So at the end of the year, they'll give their S&P 500 price target, and which is all good and well, but the question I have is, who do you believe? So you can see targets ranging from a negative 25% or a positive 18%. And really, I don't think that's helpful at all, unless you're picking the correct firm there, and you're probably not. But so really, that's a lot of confusion or technical analysis. We use it a bit as well, so I don't want to mock it, but I think you can overdo it. According to my calculations, the stock market will fluctuate. I think that's a bit of analysis paralysis. So too much information can really get in the way of making sound decisions. How about time? You know, we're all busy with our day-to-day lives and routines. And although this looks really cool, not many of us have time for it. And here's something I just pulled off a chat room. It said, I trade full time in front of my computer from the market open until the close, watching open positions, and every once in a while after market hours. So the point is, if you can make that work for you, that's fine. But the vast majority of people just don't have time for that. And here's the third barrier. Us, we're humans and we have emotion, and we seem to get in our own way. We get on that emotional roller coaster. See if you can relate to this here. As you're making money and doing well, you get euphoric, and maybe you start giving some money back, and then you give too much back and you wave that white flag of surrender and get despondent, and then things look better again and you get optimistic, and then you kind of rinse and repeat. You want to get off that roller coaster. We don't like to be on that roller coaster. We need to control our emotions, and we're going to use some technology and automation here to help us do that. So we talked about options, and Brad mentioned we do futures and options. So yes, we do futures and options, and we're going to specifically look at some options trading here. And which options are we talking about? We're going to look at stock index futures options. And there's applications for portfolio hedging, whether it's a traditional asset portfolio or speculation. These are highly liquid instruments, and these are all the major benchmark indexes for these equity index futures and options. So we're looking at the Russell 2000, the NASDAQ 100, and the S&P 500. These are the three indexes that we're going to focus on. And part of the reason why is because individual stocks are so volatile versus a stock index. Here's the volatility comparison. For example, here's Tesla versus the S&P 500. It almost looks like the S&P is a flat line compared to the volatility in Tesla over the last 5 years. Or Nvidia, look at that. In that case, it looks like the S&P hasn't even moved, but we know better, it has. And they can move in different directions, individual stocks. Here's Alibaba. It's actually down 50% versus the S&P 500 in the last 5 years. And you get a lot of these idiosyncratic moves based on company-specific news and headlines when you have an individual stock that you might be trading. Just the other week, Intel made headlines, some government involvement in Intel. The market shot up, and then it pulled back and fell apart, and then it went sideways, and it shot up again. And meanwhile, it looks like the S&P didn't even move in comparison. So that's one reason there's much less volatility within an individual index. And we're going to look at the E-mini S&P 500 futures market, and we're looking at options on that market. And part of the reason why is why look at 6,000 other securities? So we can focus on just one or two or three or a handful of markets. And also the mini is actually huge, a little bit of an oxymoron, but the E-mini S&P 500 futures market, it outtrades all ETFs around the world by a factor of 2.5 times. So that is to say 2.5 times more in average daily dollar volume versus all ETFs around the globe. So that's pretty astounding, that statistic there. And it's probably something you weren't aware of. So hopefully we learned something new here today. And looking at the options themselves, over at 1.5 million in average daily volume for the S&P E-mini options market. So one of the most liquid markets in the world. See, the volume is just dramatically increasing year after year, and 2025 is going to be even bigger than 2024. So we're looking to another language. Let's learn some Greek. We're going to look at two of the Greek letters, the Greek alphabet. Delta helps us determine probabilities when it comes to options. The definition here is what does how much does the option value change with a change in the underlying index? Or it's also the approximate probability of expiring in the money. So that's how options traders, and that's how we look at it. So if a delta is 0.25, that means at that moment there's a 25% chance it would expire in the money, and then a 75% chance it would expire worthless. So remember, delta is always moving with price and time. It's not just a number that sits still. And this is important too. It is not the probability of a winning trade. So that's something to keep in mind. And then theta is the other letter here we're going to look at in the Greek alphabet. Remember, every option has limited life. It's going to run out of time at some point. So that's called time decay. It's a wasting asset. So theta is a negative number. It equals 1 day of time decay. And if you have an example with an option at 10 points and theta is at negative 0.05, the next day the premium is 9.95, and the next day it drops to 9.90, and it continues to lose time day by day. That theta decay never quits until the option premium becomes 0. So this is what it looks like on a graph. You see the value of the option here. It just slowly starts to drop due to time decay, especially in the last 30 days. It accelerates. The premium related to theta or time really drops rapidly in the last 30 days. And so what strategies are we going to use? What are we going to talk about when it comes to options? Well, why don't we look at the strategies that professionals use? They're using multi-leg option spreads to collect premium. So they use theta decay to their advantage, and they collect premium to offset the cost of the options that they actually buy in their spread. So here's a woman on CNBC, and she made a very accurate comment here, so I like to quote her. She says, an option spread calls for buying and selling different contracts, a very common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. So this is what an example of an option spread might look like, something a professional might use, where they sell an out of the money call spread. And that would be, in this case, a bearish position. And this red line here is an option that you sell and collect premium for. And you put that money in your pocket, but then you actually take some of that money out and you buy an out of the money call spread a little higher in strike price. And that's your protection. And that's how you cover this from being a naked spread. And I'll show you a little bit more about that. But the net result is you still collect premium, and you look for the market to just basically stay below that red line, generally speaking. And this vertical line here is the expiration date of this particular example. So I just want to give you a visual of what these spreads might look like. Then here's something called an iron condor. That's a non-directional strategy where you collect premium. You sell an out of the money call spread. So you notice looks the same here, but you also sell an out of the money put spread simultaneously. So you collect premium from selling from the puts here and the calls, and you look for the market to sort of stay in that range between those black arrows. And then you see the expiration date as well. And we don't stay into these positions all the way till expiration, and I'll show you more about how that works. Here's something called the Dragonfly, a strategy that we created several years ago. And it's a variation on the Iron Condor where you collect premium by selling selling a Dragonfly strategy. And you collect premium on both the call side and put side of the spread. So this is what it looks like. And the red line there is the calls that you're selling. So you sell 4 of the red line, 6,700 calls. And don't worry about all the details. We're going to spend a little more time in the actual demo, but just want to give you an idea of what this looks like. And then you buy 1 closer to the money call, and then buy 3 further out of the money strikes. So for every short option, there's a long option. And then the same thing with the puts here, sell 4, you buy 3 further out, and then 1 closer to the money. But the net result is you collect premium on both the puts and the calls. And then what happens is you look for the market to stay essentially within that range of the spread there. So you can see it moving around. And then right here, you see this arrow. That's where we had a signal to close out the position and buy it back. So you sell it high and you hope to buy it back lower or for less money than what you originally received. And you can see this blue bar here, this square called the RTI. That's called the risk thermal indicator, and that's a signal to take profits on the position and get out. And you can see it's well before expiration. And we're going to show you how that works and how you can automate this so you don't have to screen watch like that guy that had 10 monitors. So we can automate these types of risk and profit management scenarios. And so you want to avoid what rookies are doing. We saw what the pros are doing, but it says majority of small-time traders are buying the most basic call and put options, which have a much lower probability of profit versus advanced strategies like option spreads. And here's a quote from John Foley. He's the CEO of Options AI. And right here, it says, everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. So remember, if you're only buying out of the money calls or puts, you're probably going to lose money over time. And this is interesting. And 11% of Robinhood's monthly active users made an options trade in the first 3 quarters of 2021, but fewer than 1% executed a multi-leg options trade. So what they're saying here is that this retail crowd trading options on Robinhood is only buying calls or only buying puts, basically. So those are not professional strategies. And here again, the CEO, John Foley, says, you're going to lose money over time if you're only buying out of the money, calls and puts, I would add. And then he's asking, the question should be, can I have straightforward access to the option strategies that Wall Street uses? So our answer to that is yes, you can. So these are professional option spreads created and managed for you using algorithms. So stick around. We're going to look at a demo here of the software, but also of the trade alerts. And you're all going to have a chance to respond to a trade alert live, dynamically, in real time in a demo account. You'll just simply touch your link there, or on your email as well. We'll show you how to do that, and touch accept. That'll just be a few minutes from now. So these are professional option spreads created and managed by the algorithms within Theta Trader. These are pre-built option strategies and spreads. The professional ones that we just talked about, our proprietary algo creates what we call Theta trades. And then also we have these one-touch responsive trade alerts. So you receive a trade alert and you can respond to it with the technology. You don't have to try to copy a trade alert and place your own trade. Strategies for bull, bear, and flat market conditions. And then we use automation for risk and profit tracking, and that's called the risk thermal indicator, or the RTI. Okay, so let me switch gears here, or screens, I should say. And we're going to look at a demo of Theta Trader. All right, great. You are now looking at our Theta Trader dashboard. And you'll see here, you have active trade alerts. If there's any trade alerts, they show up here on the dashboard. These are the Theta trades we talked about. Any open short positions or sold spreads, bought positions here. And this is all of your account info. And this is integrated directly with your AltaVest trading account. Now, this is a demo account I use for webinars like this. And you'll notice there are bullish strategies that are pre-built, and bearish and neutral and non-directional, as we say. And then we looked at the three markets: the E-mini S&P 500, E-mini NASDAQ 100, and the E-mini Russell 2000. And you'll see that there are pre-populated strategies for really any outlook that you might have on the market. But one thing we'll do here is, since we talked about condors and dragonflies and these professional strategies that involve collecting premium, we'll look at condors and dragonflies here. This is the NASDAQ. So you have a condor with 45 days till expiration. So that's one of today's Theta trades. And you'll see the strike prices are all pre-selected. This is your profit potential at expiration, and then the targeted annualized return on this trade. And it's really there to compare one trade to another. In fact, you'll notice the dragonfly has a slightly lower targeted annualized return, and I'll point out why in just a minute, but that's very common for the dragonfly. Essentially, you pay money to buy additional insurance on a dragonfly, but we'll get into that in just a moment. But for now, let's look at this condor for today. And if you have questions along the way, feel free to let me take a look at them. I always can't get to them right away as I'm presenting in the demo, but feel free to ask questions along the way. Okay, so the first thing I like to do, oops, I want to close that. There we go. First thing I like to do here is, sorry folks, my finger got ahead of myself there, is we're going to look at a graph of what this trade looks like. Again, I think the visualization sort of helps clarify exactly what we're trying to do. So just a nice simple graph. We don't have to overdo it with a lot of bells and whistles. And you can see this particular trade has 45 days till expiration. So here's what it looks like. You're selling this out of the money call spread and out of the money put spread. And you can see the expiration date denoted there by that vertical purple line. So you're looking for the market to stay below the red line and above the red line, generally speaking. And then this trade would do well. And you'll notice all the details on the trade on this table here. In fact, let me see if that helps you see a little bit better. I know when I look at webinars, I like to try not to, well, I'd rather look at webinars where I'm not squinting. So hopefully you can see this okay. So you can see here 45 days till expiration, the settlement value, the premium, the put risk, the call risk, the commission, your available capital, cash required, again, your profit potential, targeted return on cash, and then your targeted annualized return. And all these acronyms are explained in DataTrader. So don't worry about if you don't know exactly what that means right now. But you'll notice here, you're selling the 2800 put, and these are all pre-selected by the algorithm. And you're selling this particular call here, the 25300 call. And I want to point out something. Look at the delta on this call that is being sold, 6.66%. So you're talking over a 93% probability that this call option that you are selling to someone else will expire out of the money. And then again, the same thing with this put, 9.51 delta. So over a 90% probability that the put that's being sold, remember, you're selling the put to someone else and collecting the money. They pay the premium to you. And so there's over a 90% probability that this put you're selling to someone else will expire out of the money. So the algorithm behind the scenes decided these are the strikes to select to sell to someone else and collect premium. And then these are the strikes here to buy to protect the position against a maximum, or basically uncovered loss. So these are not naked strategies. Every option is covered in advance. And it takes, in this case, about $1,800 to place this particular spread. So the cash required is the number you're looking at there. Now you're selling the spread to someone else, so it always defaults to a sell. And the quantity always defaults to a 1, but you can raise the quantity or lower it. We'll go ahead and do 7 of these. You can see your cash required moves up and profit potential moves up, and just click place, and that's all you have to do. So it's just that simple to place an order, and now that order is placed. And what I want to do now, we're going to go back and take a look at a dragonfly. And then we're going to actually show you how to respond to the trade alert that all of you should have received by now. You would have received, by the way, a text message and an email. And we'll show you how to log in and make that work for you in your own demo account. Of course, for some reason, it's taking its sweet time here. And I mentioned the trade alerts that were all sent out to all of you who registered as well, but you see it also shows up on your dashboard right here. In fact, why don't I do this while I just refresh the page. So if you click view, you can take a look at this trade alert. And this happens to be for a dragonfly. And you can see there's a brief description of this particular trade here. And you'll notice you're selling these 4 calls here. You're buying 3 further out of the money calls, and then you're buying 1 closer to the money call. The net result is you collect premium for that transaction, and then you have the same structure on the puts. You're selling 4 of these out of the money puts, you're buying 3 further out, and then 1 closer to the money. So for every short option, you have a long option on the puts and the calls. And this is the expiration date on the strategy here, this purple vertical line. So this particular trade here has 59 days till expiration, and the quantity is pre-selected for you. So every alert that you receive is customized to you in your account. And before I accept that, let me go back and we'll just do this here on the dragonfly. Not sure why that took so long, but let's look at this dragonfly first, and then we'll look at the alert. So here is an October week 3 expiration, has 45 days. and it's on the E-mini NASDAQ 100. And you can see the algorithm has pre-selected these strikes here, the 2800 put that's being sold and the 25,200 call that's being sold. So your maximum profit potential and then the targeted annualized return. And again, here's a good visual. So you have that same dragonfly structure with the calls and the puts. We just looked at that in the trade alert. This is a slightly different trade in terms of the strikes and so forth, but it looks very similar because it is a dragonfly. And again, the same metrics here. You have everything you can review on this table. We won't go into all the details right now, but the cash required, $7,254, your profit potential, targeted return on cash, and then the targeted annualized return. But again, the important thing here is looking at, well, one of the important things, of course, would be looking at the strikes that are being sold. So this delta of 9.51, again, over a 90% probability these puts that are being sold to someone else will expire out of the money. And then 7.88 delta, so 92% probability plus that these calls that are being sold to someone else will expire out of the money. And then you can also change these strikes if you wanted, but you probably defeat the purpose because the algorithm has decided based on a lot of variables that this is what makes most sense in this environment. So it defaults to a cell of just one. We can change it to, we'll do 3 of these for the sake of this here. We're trying to collect 41.5 points, and we'll go ahead and place that order. And that's just that simple. And if it were a real account, of course, the order would be placed, and then depending if it's filled or not, you would get the report back here in ThetaTrader when the order is filled as well, and it shows up in your account. So we'll look at that trade alert here. So again, this is just a dragonfly here, and it's a non-directional strategy, and there's usually a little bit of a narrative on each trade that gets sent out here about some reasoning behind it other than just the actual algo and the numbers. But you can see your premium here, you're collecting 24.88. The cash required to hold the position, essentially your deposit to hold it, a margin deposit, 37,512. And again, the default quantity here is always going to be specific to you and your account. And any alert that you receive is actually tailored to you, because if you already had this position in your account, you won't receive an alert for the same thing. Or if you have a position that's too similar, you would not receive an alert as well. And this is really handy here. The quantity is already selected for you. So again, custom to you and your account, but you could change it if you want to reduce your exposure or reduce the position size. You couldn't go higher than what was originally selected for you. So maybe I'll just be different and go to 7, and then we'll just go ahead and accept that. So that's just how easy it works when you get a trade alert. I just wanted to point that out. And then we'll refresh the screen here. And now that I've accepted that alert, this trade here will be disabled, so to speak, so you won't be able to place the same alert twice. So here's another really great feature. There's a trade simulator in ThetaTrader, and I've created a couple here so we can look at together. So here's a trade from May 27. It's just an iron condor in the June in the month, and we'll use these buttons to go backwards and forwards. So you can go forwards in time, backwards in time. You can go all the way to the end, but I just want to play it and kind of explain what's going on. You see when you place the trade's a little bit negative, the red P&L, and that's because theta decay hasn't worked yet. But you see the RTI is green, and that means good, do nothing. So again, you sell this out of the money call spread and this out of the money put spread, you collect premium. Here's your expiration date. And you look for the market here to really stay within this range, below the red and above the red. Generally speaking, that's kind of what you're looking for. You can see day by day, and then you get a blue, and that's a profit taking signal. So ThetaTrader says, take profits on this day and get out of the position and go on to something else. And you can automate this, and I'll show you how to do that. So you do not have to screen watch or babysit. Theta Trader monitors your positions, but you can see that's just a fairly basic iron condor result when the market goes kind of sideways. And we'll look at the same trade setup and compare it to a dragonfly. So again, this was on May 27 and the June end of month condor. So we'll look on May 27, the June end of month dragonfly, and let's compare the two. How do they behave? Well, look at this. On June 16, with 15 days till expiration, you have a profit-taking signal. Now compare that to the condor. Your profit-taking signal here was on June 20th. So you had to wait an additional 4 days before you generated a profit-taking signal on the condor. So you can see the different structure of the dragonfly can often work to your benefit, where you can close out a position earlier and take any gains and move on to the next position, next strategy, next trade, whatever it is. And that's simply because the dragonfly is a different structure. You own this call here and you own this put, and that's an additional bit of insurance, so to speak. So you pay additional money for some insurance, and some of the benefits are you can get out earlier. And let me show you some of the other benefits. So here's a August condor on the end of month expiration. So everything is kind of moving along fine. And then you get out on August 6th. And we're looking at the same thing. Instead of a condor, it's a dragonfly. And let's see, I forget what happens here. I think maybe just another earlier exit. Yeah, so August 4th. So this gets out 2 days earlier than the condor, and that can be a big difference. It's always best to take your money and run, so to speak. So you can see the benefit of the dragonfly and having that additional long call and put, that additional structure there. So here's another condor versus dragonfly. Let's take a look here. Okay, now this one went bad very quickly. You can see what happens. It gets yellow, elevated risk, and it gets orange, even higher risk, then it gets red, and that says there's too much risk, take your loss on the trade and move on. And this can be automated too, and I'll show you how to do that. So this trade ends up being a loser on this May end of month condor. Now, instead of a condor, what if you had done a dragonfly on the May end of month expiration? So on the same day, so we can see here April 30th. Just want to make sure we're doing apples to apples. Yep, April 30th. So same day you place a condor, and the same day you place a dragonfly. You see the condor had a loss. The dragonfly coming under a little pressure here. Yellow, but still do nothing. Turning orange, but still do nothing. And then it turns green again. And then it turns blue. So you actually end up taking a profit on this dragonfly versus the condor. So you see how much having this long call option here as protection, it helped you, and you were able to kind of withstand some pressure, and then the trade ended up being profitable. So we like the dragonflies a lot. You give up a little profit potential, but the trade can be more robust, and it can at times keep you out of a loss and also allow you to get out of a trade earlier. Then here's something here I'm going to go back and show as well. Again, not just neutral strategies, but there's bearish and bullish as well. Something called a bear hedge or a bull hedge. For example, it's just a combination strategy where you're selling in this case, a bear hedge would be sell out of the money call spread, collect the premium, and then you take that money you received, and then you use it to buy an out of the money put spread. But also want to point out, there's basic call and put spreads as well. You could just buy a put if you want. So it's not always a non-directional strategy. So this is a directional strategy. This is a bear hedge. You could do a bull hedge as well. Simply a combination where you sell this out of the money call spread, collect premium, and then you use that premium to buy an out of the money put spread. You can usually do this for even money, so it doesn't cost you anything, even get a credit sometimes. And then if the market were to subsequently decline quickly, this trade should probably do well. But you can see here, similar table on this here as well. And we'll look at a bear hedge example just from earlier in the year. The colors are different because you actually buy the spread, so don't worry about the colors. And you can see the market's declining quite a bit. The P&L on the trade is very profitable. And then you could hang on to it or, close out the position if you'd like. But just an idea for you, there's non-directional strategies and directional strategies that are spreads. So you can incorporate selling options in both cases. And let me show you here what else Theta Trader can do, and then we'll get you set up with your own alert. So there's something called Trade Scope that we do every day. We do some very straightforward analysis on some technicals, but we also really look at option flow and positioning. And then we have a market outlook here as well. And that gives a lot of great information in just several minutes. It's just this one page. People like to use this and kind of start off their day. And then let me show you how to handle your automation. So you go under your account, you go to settings, and then here's this risk manager. You activate that, and you can actually customize the risk level. So right now it's on red. The default risk level is 0.5, or you could change it to 0.38, or it could customize it anywhere from 0.5 to 0.25. See if I can increase that. Yeah, you can probably see that better. Now, you're perfectly welcome to make changes, but if you were to go from, the red 0.5 default level and change it to say 0.25, keep in mind the frequency of losing trades will be greater, but the magnitude of the losses will be smaller. So that's the trade-off. And I just leave it here for this account, for the demo account at a 0.5. Then you click Save Settings, and then you activate Profit Directive. Same thing there with the button, and you just save your settings, and that's it. That's how you automate Theta Trader. It's just that simple. Kind of a hands-off approach to managing the position. So it's kind of having a profit order in place and a stop loss in place ahead of time is really what it amounts to. And then there's a great help file here. Let me show you that. Here's an example. We're not going to go through all of it, but here's all the color coding, and it's all described here on the RTI, and a glossary here of all the strategies. And then also, we have a great education section here, sort of a master class in education. These are all recorded videos, and these are really what we say is what you really need to know about trading options. It's right here. This is all available as part of Theta Trader. And then there's also tutorials here on placing trades and navigating and so forth. But you see how easy Theta Trader is. It's very intuitive. But I did want to point that out. A lot of useful tools here right under this section. And if you want to look at your positions on your dashboard that are currently open, you can see them all here. These are your bought positions, your open positions, but also you can look at closed positions here. And you can filter here any way you like for the month and the date and the market or whatever. And there are 20, let's see, yeah, I guess there are 20 on each page right here, 20 closed positions. Now this is just a demo account, so don't make too much of it, but you can see how, well here, there are 20 trades on the account, on the page, on this page, and 17 winners and 3 losers. And here are the gains. But here's the thing, 14 are short positions. Basically, you're selling and collecting premium. So we talked about professional strategies using spreads to collect premium, using covered strategies. So you can see here the probabilities, at least in this particular streak of trades. I mean, that's a pretty good result, but you're not going to get 100% winners all the time, obviously. But I just want to compare the short positions. You have 14 winners, 0 losers. Now look at the bot positions, 3 winners and 3 losers. So that kind of makes sense. You're not often going to have nearly as many winners when it comes to your long or your bot strategies versus the short premium strategy. So just want to point that out. And now why don't we go show you how to take a look at your own trade alert. And if I can successfully switch screens. This takes a second, folks. Okay, so here's how to respond to your trade alerts with one touch. And these are integrated alerts, they're live. So you touch accept and the order is placed on your behalf. Our technology handles everything for you. So here's an example. You'll receive a text message with a link. You would touch that link and it takes you to the alert page. So this might look familiar. This happens to be a dragonfly. So there's an explanation, has 66 days. You see the calls here, the puts, you see the vertical line there representing the expiration date. You see the quantity is pre-selected in this case, 7. And you can change the quantity by lowering it if you'd like, but you cannot increase it. There you go. And you can see the premium being collected, the cash required, and then you just touch accept, and that's it. That's all you have to do. And then the order's placed. So here, it's time for all of us to receive and then reply to your demo trade alert. So you should have all received a text message from us, whichever phone number that you used to register for the webinar, and email. You can check your email as well. And then you'll just click that link. And here's how it works. Your username is going to be the prefix of your email address that you use for registration. So whatever you have in place for your email that comes before the @ symbol, that's the username. And the password is lowercase options, OPTIONS. So I'll give everyone a moment to give that a try. So basically you're gonna just use that username. It's the prefix to your email address. So everything before the @ symbol. And then the password is options. And then click login. And then you should see the alert. So let me know, folks. Put something in the chat. Let me know if that's working for you. People have fun with this when we do it in the webinars, and give me the thumbs up. We won't hang out too long here, but let me know. Yep, thanks, Roy. Thumbs up. Okay, so it's all working like it should. Isn't that great when technology works? So you all have demo accounts, and you can all use them in the near future here for the next 60 days. So you have your login and your password, and you're all set up. And what you can do to make sure that you have your automation set up is near the top right under the My Account setting. Recall that you go under Settings and then go to Account Settings and make sure to activate your Risk Manager and activate your Profit Directive. All right, folks, so that's great stuff. And we're going to show you how you can get involved and get started with ThetaTrader. So it includes everything we talked about, the software, which is all of the theta trades, the RTI, that's the color coding automated risk and profit control. Then you have the trade simulator available to you as well. You saw how well that works, what a great tool that is. And you can go spend time in the simulator and sort of back test. It's like a time machine, so it's a lot of fun to use and valuable. It's a valuable tool as well. So everything included with the Theta Trader, including the one-touch trade alerts. Everyone loves these alerts. They're very convenient, and you have access to these professional strategies. So people have a lot of fun with those alerts, valued at over $4,400 on the Theta Trader and the trade alerts. So $8,052 value on all of that software. And then you have private coaching. This really sets us apart from kind of an online only type of environment. You have private classes. Anything that you want to talk about, we'll share the screen with you. And we're all licensed and experienced, and we're here to help you. It's in our interest that you do well. So how much does coaching typically cost? Here I found this. Comprehensive packages with mentors typically range $5,000 to $15,000 for trading coaching. In fact, I've seen numbers higher than that. I've had people tell me they've paid $25,000. So we offer this coaching. It's all part of the Theta Trader package. You have a co-pilot. You develop a relationship with someone who's experienced and licensed. So is it a $10,000 value, 20,000? I don't know exactly, but let's just say it's a split the middle there. We'll call it a $10,000 value. So everything in Theta Trader, including private coaching, over $18,000 of value. And then this, that's always kind of corny. There's more, kind of an infomercial. But remember, we have the TradeScope daily research as well, keeping you informed. Then we mentioned in Theta Trader the education. We have a futures and options masterclass. You have all the various chapters here. Futures overview, stock index futures versus cash options, futures options in particular, advantages of stock index option spreads, and then advanced stock index futures options. So that's all available. That's all part of the Theta Trader package. That masterclass valued at almost $2,000. So we've got the online tutorials. That's just part of the Theta Trader package. Just thought I'd remind you of that. So again, everything Theta Trader, the alerts, the private coaching, and the research, the education, the masterclass, valued at over $21,000. But of course, that's not what we're going to offer this at. So we used to do this in live events for $4,000, $39.97. And then we used to do it at $9.97 in other webinars and presentations, but we've reduced it here to $5.97. That's a lifetime membership, and that's one payment only. So here's the link to do that. In fact, why don't I put that in there, cf.altavest.com. Okay, and then you can use the QR code as well. And that's my direct phone number and email if you have questions. But that's just one payment of only $5.97. And you can get a free membership. You have $100,000 or more, we'll just rebate that membership fee. $50,000 and above, you get a 50% rebate. So people love taking us up on that offer. And then there's a money back guarantee on the membership. So you sign up with us and within 30 days you think this isn't for me, or whatever reason you have, it doesn't matter, we'll just refund your membership fee. So you don't have any risk in becoming a member and taking a deeper dive. So again, just to kind of, I kind of briefly touched on this, but what are some of the advantages of ES options or E-mini S&P 500? The large market share. So you have strike prices available. So the Theta Trader algorithm is able to build these spreads because of all the strike prices available. So deep liquidity across a wide array of maturities and strike prices. You end up with superior execution compared to SPX. And these options offer cost savings of $4 to $15 per contract. And that's according to the CME group. So you get those tight bid offer spreads. in these liquid markets. And then another advantage in doing what we do is there's no margin calls. Because of our approach, we only trade covered option strategies. There's never a margin call, no naked options. Everything is covered. So no unlimited risk, no margin calls. So this is a good joke. She's asking who is margin and why does she keep calling you? So no margin calls, folks, when you trade with covered strategies. And there's no pattern day trading restrictions when you're trading options with us. If you're trading in securities, you're subject to additional regulatory scrutiny. You become a pattern day trader, someone who executes 4 or more day trades within 5 business days. So once you're triggered and once that's triggered and tagged, that's it. Your account is now set up and you're reported to the SEC as a pattern day trader. So you're under additional scrutiny. If your account falls below 25 grand, you can't make any more day trades until you bring the balance up and so forth. So you want to try to avoid that. It's not the end of the world, but there's none of that nonsense with us. So we can trade any commodity futures and options market. We're full service. So we talked about the E-minis and Theta Trader and the option spreads, and we do a lot of that, but we have plenty of clients that do commodity markets, futures contracts in general, crude oil, gold, corn, treasury bonds, you name it. Gold's been in the news. Well, actually, it probably should be getting more headlines, but commodity futures markets, we talked about stock indexes. That's a big focus of Theta Trader. So like I mentioned, some of the markets, corn, treasuries, Eurodollars, currencies, S&P 500 index, the NASDAQ 100 index, silver's on the move too. Small moves have a big impact when you're trading futures. Every futures contract is leveraged. I won't go into all the details here, but this is probably a good summary. When you're trading futures, your ratio of capital efficiency compared to, say, ETFs or a basket of stocks is, 10 times greater. So that's inherent to futures trading because of the leverage. There are micro contracts available too, if you're trading something like silver or gold or energy. So again, just Theta Trader is unique. You have these strategies that don't rely on a particular narrative or the stock market always having to go higher. And you're going to want to think about diversifying your traditional portfolio as well. You've got inflation always eating away at our purchasing power. Isn't that crazy? $1 in 1913 bought 30 Hershey's chocolate bars. Anyway, it doesn't even buy a cup of coffee now. So, here's another graph of it, another way to look at it. And why is that happening? Well, look at the inverse relationship between government debt and the value of the dollar. So it's really just a perfect inverse correlation there. So here's what your dream house looked like as a kid, and now here's what it looks like. So I think it's important to have some strategies that can perform when other things aren't performing. You've got inflation here. This is according to headline inflation, this red line. But here's an alternative calculation of inflation. And then here's the price of gold. So interesting, gold's kind of seems to believe the alternative calculation, not the headline calculation. So real inflation, as we know, is understated. Here's Alan Greenspan. Gold is a currency. No fiat currency, including the dollar, can match it. If gold is a relic of history, why do central banks plus the IMF still hold over 1 trillion of gold? If it's meaningless, why is everybody still holding it? And that was when gold was at 1800, just 2 years ago. So I'm just kind of picking on pointing out gold here as well, because a lot of clients like to trade gold with us too. And that's been the best performing asset in the last 20 years. Look at the difference here between gold, the S&P, and the Russell. So you've got gold here, the S&P, and the Russell 2000. And in the last 2 years. And one thing to keep in mind, stock market drawdowns, they can last longer than you think. I think we have kind of a recency bias because pullbacks have always been met with a lot of buying lately. But keep in mind the NASDAQ. Some of you remember the NASDAQ reaching over 5,000. Then it was down near 1,000 just a couple years later, and it took 15 years to recover. So if you ended up buying at the wrong time and just sat on it, and that doesn't even account for inflation eating away as well. So inflation adjusted, it probably took, another 2 or 3 years to make up the difference. So all I'm saying is you don't want to rely on just being passive. It's important to have some alternatives in your back pocket. So a low correlation, that's what alternatives are all about. They offer absolute return possibilities. So you can allocate to alternative investments, such as what Theta Trader is doing and what we do with futures and options. And you might have a section of your portfolio allocated to the alternatives. So to summarize, these are flexible strategies for all market conditions. You can do professional premium collection with the simplification of Theta Trader and the ease of use and the convenience and the automation. You can use these strategies to diversify or hedge, and you have those one-touch responsive trade alerts, and then you don't have any of the pattern day trader restrictions. So you can respond to those trade alerts in all these different ways that we just talked about, just touching accept, or even via email. And then of course on your phone, you can change the quantity if you want as well. And then that's a lot of information, folks. So anyone have any questions? Let's see, I have a couple in here. Yeah, everything is browser based. So you don't need to download an application of any kind. Or when I say application, like a software app. So good question. Yeah, the commissions are 5.25 on the e-minis. So good question. And that's net. That's inclusive of all additional clearing and exchange fees and NFA fees. And you can go online, you can look at big box brokerage firms, and they might have a rate that says, $2.50 for futures options. But if you look at what they're telling you, that's only per side, and it doesn't include clearing and exchange fees. So our rates are very competitive. And what else is there? No, we're not doing any scalping, but thanks. That's a good question, though. We're not doing those types of high frequency trades or anything that is moving that quickly. I mean, we may occasionally have a trade with a short-term, days till expiration, but by and large, we're not doing that type of trading. And let's see here. I'll leave this up. So there's the link to become a member. We can get you onboarded. You can ask us questions. You can have access to all of the strategies and all of the theta trades, all the alerts, and I think you'll really enjoy using it. There's the QR code as well. So it's a great value, and we'd love to have you give it a try, folks. So you heard from Brad, who started out and talked about using equity trust as a way and a means to using the tax deferral to your advantage, and using, and I talked about the strategies available for futures options and futures. So there's a great partnership there. You've got a mechanism to, experience the advantages of the tax deference, and then you have the self-directed trading available to you here with the convenience of all the automation that we make available and these professional strategies for trading options and futures. So we think it's a great partnership for people that are looking for that type of thing. And let's see if Brad is still with us. Just want to say thanks for joining us. And there he is. Thanks, Brad. That was very helpful. I learned a lot.
Yeah, no, that was a lot of fun. I learned a lot as well. I think some of those tools and the automation you guys have around them are amazing. So yeah, again, great partnership between Equity Trust and AltaVest, just trying to create the ability for you guys to maximize your wealth potential and save some taxes along the way. So thank you for everyone for joining us today.
Yep. Thanks, everyone. Thanks, Brad. And we'll sign off, and we'll leave this up here for a few minutes, but look forward to welcoming your calls and emails and questions and comments. So we'll talk to you soon. Bye-bye.